Hello, Deep Value community. Thank you for watching. This is our value investing journey. So as always, please subscribe so you can get my next video installment helping us go on our value investing journey. So today I'm going to try and address what I believe is the most important question in investing. When to sell. I believe that when you sell is what defines you as the investor. Allow me to explain this further. Everybody kind of understands more or less when to buy. You want to buy when you believe that there is more value to be held in the future. You want to buy something for less than it's worth. Everybody kind of understands that. But the selling time frame changes. Some people want to buy for 6 months. Some people want to buy for a year. Some people want to buy for 2 years. Buffett historically would say, I want to buy and hold forever. So a lot of investors, particularly of an older generation, very much like to repeat this, as their holding period is forever. And they're going to leave their investment to their children. Now, the first thing is that is just detracting from the question. Is there value in the business? Because we're going through unprecedented change. There's so much change, and what historically was a strong business no longer is true today and might not even be true over the next 3-5 years. Technology rapidly changes. So I don't believe that buy and hold forever works that well. And we saw just a few weeks back, Buffett sells some of his airline stakes. So even Buffett no longer believes that buy and hold forever is necessarily the best thing. And if you read his 2 or 3 most recent annual letters, he talks about that the portfolio is going to be slightly more liquid. They're going to be entering and exiting positions with some more vigor than they have in the past. Buffett talks about that an investment such as Apple is a very long has a long history of being such a strong competitive advantage, and even then Apple Buffett has sold a portion of Apple. So I don't believe anymore in this kind of idea that you should buy and hold forever. I think you should buy and hold until it makes sense, because your ability and my ability to find the next Apple is very, very difficult. It's not, you can look in hindsight and say, oh, I recognize Apple's going to go and do something, but that's looking in hindsight. To look today and try and find what's the next Apple, what's the next Amazon. There are many people that are trying to do that, and very, very few succeed. It's what Joel Greenblatt calls the tyranny of the anecdote. So you should not try and play the game where the odds are against you. The odds of you finding the next Apple that is already not priced to perfection is very, very difficult. What I believe is a more realistic opportunity is for you to buy something for less than it's worth and then attempt to sell it. So let me go in further here. So I wrote about this recently. When should you sell? So I believe that there are 3 criteria to help you decide when to sell. So one of the things that I look at is when the company has started to move into the right direction. So I'm buying an average company. An average company goes up and down over time. It may go up and up and up and up over a period of, let's say, 10 years, but it doesn't go up in a straight line. And there are periods of despondency. There are periods where the investor feels very, they don't want to be invested in that company. And there are periods where nothing the company can do can be wrong. So the management is amazing and people come out with all kinds of justifications for paying for the multiple. What they're really looking is for, when the share price is going up, they believe that the management is doing something better. That's not true. So I believe that the best way to do it is to have, before you make the investment, write down on a piece of paper in 3 points why you want to hold this business and at what price you're going to sell it. I think that this is absolutely fundamental. You need to say in your mind at what price would you sell this business. So one of the things that I do is once the business is going up somewhere between 50 to 100%, I start to ease out because I know that my investments are average investments. I cannot expect there to be, let's say, a 10 bagger. That's not realistic. The next thing I like to do is I like to kind of have an exit strategy approximately 3 years time. So this is not a hard rule, but if I've invested in something and the business has gone nowhere in 3 years and the value has not grown of my shares has not grown over a 3 year period, whatever I thought 3 years ago was wrong. It didn't matter what I thought because 3 years later, I'm still in the same point or I'm holding a loss. So you need to be very frank with yourself about the timing. So I think for myself, in the investments that I look at these established businesses, if after 3 years I'm not holding a significant gain, I was wrong. It's okay. It happens. You're going to be wrong a lot of the times. John Templeton says that even the best analyst is only going to be right 2 out of 3 times. This means 1/3. 33% of the time, the best analyst in the world is going to be wrong. So if you just right, just slightly more than 50%, over time, this really works in your favor. So I believe that a 3 year holding period is helpful. Another thing that I like to look at is the price to cash flow multiple. So I like to buy businesses at less than 6 times free cash flow. So remember, free cash flow is cash flow from operations minus capital expenditure. I also like to think about how much of that cash flow is towards stock-based compensation. So I like to make an adjustment for that as well. Some businesses, like software as a service, particularly new businesses, the stock-based compensation is very significant. So it makes sense to make an adjustment for stock-based compensation that is added back. Certain businesses, that's their running cost. Their running cost is to keep strong management, talented management. That's their cost. They're not paying for a factory somewhere overseas. They're paying for management. So they're getting paid in stock-based compensation that gets added back. So I would factor that in. So I like to pay less than 6 times free cash flow. And when the business is going up to approximately 12 to 14 times free cash flow, I would look to exit. And there are 2 reasons why the multiple would go from 6 to 14, let's say, times free cash flow. One reason is that the businesses over time, its free cash flow has dwindled, has come down, so the multiple has expanded. So I thought that looking on a trailing way that I was getting a value investment, but over time the value has dwindled, the free cash flow has dried up, so the multiple has expanded, so I was wrong and I'm out. Another reason could be that I've actually made the right call, the business is more stable than investors were predicting it to be, I was right, and they're willing to pay a higher multiple for the free cash flow of the company. And just one more bonus thing. So the amount of the multiple that investors are willing to pay is very much dependent on the growth of the business. So for example, I'm unashamedly bullish Facebook. I don't hold a position in Facebook. And I can see an argument for that business to be priced at a high free cash flow multiple, significantly higher than 6, approximately 20 times, because I believe that business is going to be growing at, let's say, 23-25% year over year over the next 2 to 3 years. So in this example, I believe that it's worthwhile paying significantly more, but I don't typically go for these high-flying businesses. I typically go for a business that's only growing slightly better than inflation. So in this example, I prefer to try and buy for less than 6 times free cash flow And when the business comes close to 12 to 14 times free cash flow, I would believe that I've realized the value of the business. So as always, thank you for watching. Please subscribe. I'll see you next time.